Swayam Prabha. Digital India. Educated India.
Yogah karmasu kaushalam.
Hello friends, let us begin understanding accounting for non-trading concerns. In this module, we will understand about 1. Meaning and characteristics of non-trading concerns. 2. Difference between trading and non-trading concerns. 3. Components of final accounts of non-trading concerns. 4. Meaning of capital income and revenue income and revenue expense and revenue expense. 5. Difference between capital income and revenue income. 6. Difference between capital expense and revenue expense. 7. Deferred revenue expense. 8. An illustration. We will commence with the basics of non-trading concerns. The basic objective of any business unit is to earn maximum profit. It is also valid that to sustain in the field, one has to earn profit. Business enterprises are preparing their P&L account or income statement to measure their profitability status. In addition to that, picture of economic condition is equally important, and for that purpose, balance sheet is prepared. Unlike business enterprises, non-profit making organizations are also working. Their basic objective is to provide services to their members or to provide services to the society. There are several institutions in the society, those who do not have an objective of generating profit. They have an aim to serve the society, to provide facilities and services to the members, to undertake activities for the welfare of the members, to extend academic activities with an intention to develop academic, social, religious, cultural or art related and donation generating activities. These kinds of concern are known as non-trading concerns. These organizations are also required to prepare and present their annual accounts. Since objective of non-profit making organization is different, thus there is some different components considered for preparation of annual accounts. There are different types of organizations which provide services to their members. These organizations are like sports clubs, hospitals, educational institutions, religious organizations, housing societies, etc. Let us understand meaning and characteristics of non-trading concern. Meaning: non-trading concerns are working with objective of service rather than profit generation. They provide services to their members. Example, Gujarat Sports Club provides sports related services to members and members pay different types of fees to the club. Another example is Radha Charitable Hospital, where medical services are provided by the hospital with minimum charges. This hospital receives donations from across the world. This hospital is providing services to the society. Its services are not confined to the members but extended to the society at large. In these concerns, sports clubs, Rotary, Lions Club, trade associations like the Chamber of Commerce, political associations, labor associations, medical associations, public hospitals, charitable concerns, library, educational institutes, associations for cultural activities, orphanages, religious organizations, etc. are included. Such organizations generate income for their activities and pay the expenses, but the intention is not to earn profit. Example, Rajpath Club, Ahmedabad Gymkhana, Maniben Library, Jivraj Mehta Hospital are some illustrations of non-trading concern. Features always explain functions, process, scope, etc. of any concept. Let us see the features of non-trading concern. Features 1. Service to member or society. Such kinds of concern are established with objective of service to the members or to the society at large. These kinds of concerns do not have profit earning objective but has service objective. This is a very important feature of non-trading concerns. 2. No trading account. Since these organizations are not dealing for any trading activities, therefore not required to prepare trading account. In case of hospitals, medicines are purchased and provided to the patients. In case of clubs, certain items are purchased and provided to the members, but the purpose is not of trading, hence they do not prepare trading account. Third, income expenditure account. The profit and loss determination of business is done through profit and loss account. These concerns are established with no profit motive. Thus, preparation of P&L account is not applicable to them, but it is equally important for these concerns to know condition of incomes and expenses. These types of concerns prepare income and expenditure account in place of P&L account. They do not ascertain profit or loss, but ascertain excess of income over expenses or excess of expenses over incomes respectively. This is one of the components of annual accounts of non-trading concerns. Fourth, receipt payment account for cash transaction. In case of trading concerns, cash account is opened for cash transactions. But in case of non-trading concerns, receipt and payment account is opened and all cash transactions are recorded in this account. This provides closing balance of cash. Receipt and payment account is another important component of annual accounts of non-trading concerns. Fifth, balance sheet. The purpose of balance sheet preparation remains same irrespective of trading and non-trading concerns. It indicates financial status of the respective concern. 6. Capital fund. Capital is that amount which is provided by owners of the business on permanent basis. In case of non-trading concerns, capital fund terminology is used. This also special feature of non-trading concern. 7. Subscription. The regular income of trading concerns is sales of products or services, but the main income of these kind of concerns is subscription. This amount is collected on yearly or monthly basis from the members. For the members, in addition to this, the income is obtained through donation, government aid, income of interest on investments, dividend income, charity, etc. Since we are acquainted with the features of trading concern, now let us understand difference between accounts of trading and non-trading concerns. From the viewpoint of accounting, trading and non-trading concerns have their own existence, but accounting rules are same for both. That we have seen in the given figure, it explains most of the things are same in both cases, only certain items are not similar items of trading and non-trading concerns. Let us understand point-wise difference. Meaning and objective. The firms which are engaged in business related activities is known as trading concerns. Every business firm has objective to make profit from business. Business activities mean purchase at cost price and sold at purchase plus profit. In case of non-trading concern, this kind of units do not have any business activity. They are set up to serve members of society at large. Their objective is not to make profit. The profit terminology is not for such kinds of organization. 2. Trading account. In accounting, there is provision to compute gross profit or loss. In case of trading firm, gross profit or loss is determined as the case may be. To know the gross profit or gross loss, this account is prepared at the end of accounting period. While in case of non-trading concern, trading account is not prepared. Non-trading concerns do not have any objective to make profit, as well as they do not undertake purchase, sale of goods. So, they are not required to prepare a trading account. It is irrelevant account for non-trading concern. 3. Measurement of earning capacity. After preparation of trading account, to know the earning capacity means to know profit and loss of the unit. Trading concern prepare a profit and loss account. In case of non-trading concern, instead of P&L account, a non-trading concern prepares a income and expenditure account to know excess of income over expenditure or excess of expenditure over income in place of profit or loss respectively. 4. Ascertainment of result. For every accounting year, P&L account is prepared to know earned profit or incurred loss. The result is observed in terms of profit or loss. In case of non-trading concern, ascertainment of result is in the form of either excess of income over expenditure or excess of expenditure over income. 5. Source of revenue income. The main source of revenue income is from sale of products or service in case of trading concern. In case of non-trading concern, there are different sources used by non-trading concerns. The main source of income for non-trading concerns is the subscription of members, entrance fees, donations, as well as incomes from other main activities. 6. Components of final accounts. In case of trading concern, trading account, P&L account and balance sheet are prepared. In case of non-trading concern, income expenditure account, balance sheet, and to know the cash balance, receipt and payment account is prepared. 7. Capital fund. In trading concern, the difference of amount of assets and liability is capital. In non-trading concern, the difference between the amounts of assets and liability is capital fund or permanent fund. 8. Cash transactions. All cash transactions in case of trading concern are recorded in cash account. In case of non-trading concern, special account is opened for cash transactions is receipt and payment account is prepared. After having information about difference between trading and non-trading concerns, let us study the components of final accounts of non-trading concern. It is necessary to note here that non-trading concerns follow mercantile system of accounting. Mercantile system is such system where transactions of current year are considered whether cash payment is made or not of that respective transaction and whether cash received is received or not for that respective transaction. There are three important components of annual accounts of non-trading concerns are receipt and payment account, income expense account, balance sheet. 1. Receipt and payment account. In accounting, cash transactions have relation with previous year, current year and next year. All kinds of cash transactions of all years, irrespective of their nature, capital or revenue, are recorded in the receipt and payment account. This account has similar nature to cash account. In this, cash capital and revenue incomes and capital and revenue expenses are recorded. It commences with opening balance and closed with closing balances. This balance is transferred to the balance sheet. It would appear at asset side if it is cash or bank balance. It would appear at liability side if it is a bank overdraft. 2. Income and expenditure account. This account is similar to the profit and loss account of trading concerns. The income and expenditure account prepared on the same rules as the profit and loss account is prepared. The only revenue incomes and revenue expenditures of current year are disclosed. The excess of income over the expenditure of this account is added to the capital fund in the balance sheet. The excess of expenditure over income is deducted from the capital fund in the balance sheet. Alternatively, the balance of income expenditure account is disclosed separately in balance sheet. Third, balance sheet. At the end of the year, to know the economic status, the non-trading concern prepare a balance sheet. Capital is known as capital fund or permanent fund by these kinds of concerns. The remaining items are similar to the balance sheet of the trading concern. Example, assets, income, received in advance, income outstanding, prepaid expenses, outstanding expenses, payable and receivables, etc. The balance of income expenditure account available in form of excess of income over expenditure is added to the capital fund on the liability side of the balance sheet, and the excess of expenditure over income is deducted from the capital fund on the liability side of the balance sheet. Friends, next point is about understanding capital income and revenue income and capital expense and revenue expense. This classification is very important because these classifications decide the place of each of income and expenses in the final accounts. First, we will understand classification of incomes. Incomes are of two types. 1. Meaning of capital income. This income has special features like 1. This income is not regular in nature. 2. Further benefit of this income is obtained by non-trading concerns for longer period of time. Example, donation received for a specific purpose, legacy, life membership fees or life subscription, loan borrowed, etc. These incomes have almost zero reoccurrence, are not regular in nature. Their retention in non-trading concern is not for 1 year, that is for short term period. The capital income received by non-trading concerns other than loan borrowed like donation, legacy, etc. are capitalized and added to the capital fund. These funds are permanent funds for the concern. These funds are not for specific purpose, thus added to the capital fund. In addition to this, the prize fund, construction fund, etc. are disclosed separately at the liability side of the balance sheet. These funds are received or obtained for specific purpose and are to be used for that respective purpose only. All capital incomes are disclosed in the balance sheet at the liability side. 2. Meaning of revenue income. Quality of revenue income is of reoccurrence. In accounting, such reoccurrence is happening on a regular basis or at specific intervals. But ease dealing is continuous in nature. Income of the concern which is regular in nature and arising from the activities of concern is known as revenue income. Its important features are 1. This income is regular in nature. 2. The benefit of this income is available for that respective accounting period. Example, annual subscription of members, fees, interest on investments, sale of old newspapers, income of entertainment program, rent, income of sports ground, lockers rent, rent of hall, income from amenities provided to members, aid received from the government. The revenue income is disclosed at the credit side of income expenditure account by the non-trading concern. For better understanding about the difference between capital income and revenue income, let us study point-wise difference about them. 1. Meaning, capital income has special features like this income is not regular in nature. 2. Further benefit of this income is obtained by non-trading concerns for a longer period of time. And 3. This income is used to acquire non-current assets. In case of revenue income, its important features are that this income is regular in nature. The benefit of this income is available for that respective accounting period, and these incomes are used to meet day-to-day expenses. 2. Objective. For long-term investment, long-term capital is procured. These investment may be for acquiring building, ground, equipment. That is capital income. In case of revenue income, the objective is to procure regular income to meet regular expenses. 3. Presentation in accounts. Capital income is disclosed on the liability side of balance sheet. In case of revenue income, it is disclosed in the credit side of income expenditure account. 4. Closing effect. Every year, the closing balance of capital income is carried forward in balance sheet at liability side. In case of revenue income, closing effect may be either 1. In form of excess of income over expenditure, which would appear at the liability side of balance sheet as a reserve and surplus, or 2. Excess of expenditure over income, which is deducted from surplus and reserves, which is shown at the liability side. 5. Illustration. Donation received for a specific purpose, legacy, life membership fees or life subscription fees, or loan borrowed, etc. are not regular incomes, so are capital incomes. On the other hand, revenue incomes include such as subscription, locker rent, sale of old newspapers, rent of hall, interest on investment are regular incomes. Now, second is classification of expenses. Expenses are of three types. 1. Meaning of capital expense. This expense has special features like 1. This expense is not incurred regularly, and 2. The benefit of which is available to the concern for a longer period of time. 3. These expenses are done for acquiring non-current assets. Example, land, building, machinery, investments, books for library, X-ray machines, sports equipment, swimming pools, etc. Capital expenses are disclosed at the asset side of the balance sheet. Apart from the purchase price of the assets, its installation expenses, stamp duty and document expense, expense incurred to increase efficiency of assets are also capital expense, which is added to the cost of the respective asset. Second, meaning of revenue expense. Expense which is incurred on regular basis to run a routine activity of the concern and the benefit of which is available to the concern for the respective year only is known as revenue expense. Special features are 1. It is regular in nature and generally received or collected on monthly, bi-monthly, quarterly, etc. basis. 2. Benefits of these expenses are available for respective accounting year. 3. These expenses are debited to income and expenditure account. Example, salary of employees, rent and taxes, postage expenses, telephone expenses, stationery printing, entertainment program expense. subscription of newspapers and periodicals, assets repairing expenses, depreciation on assets, ground maintenance expense. After having information about capital expense and revenue expense, let us see difference between them. Difference between capital expense and revenue expense. 1. Meaning. Capital expense has special features like 1. This expense is not regular in nature. 2. Further benefit of this expense is obtained by non-trading concerns for longer period of time. And 3. This expense is incurred for acquiring non-current assets. In case of revenue expense, its important features are that 1. This expense is regular in nature. 2. The benefit of this expense is available for that respective accounting period. And 3. These expenses are done for routine activities. Second, objective of capital expenditure is either to acquire non-current assets, and with their help such assets incomes are generated. In case of revenue expense, the objective is to run routine activities of concern to provide regular service to the members. 3. Presentation in accounts. Capital expenses are disclosed on the asset side of balance sheet, while revenue expenses are disclosed on the debit side of income expenditure account. 4. Closing effect. Every year the balance of capital expense is carried forward. Generally, these expenses are in form of assets. In case of tangible assets, depreciation is charged and net amount is shown. In case of intangible assets, applied amortization is done and net amount is shown. In case of revenue expenses, closing effect may be either 1. In the form of excess of income over expenditure, which would appear at the liability side of the balance sheet as the reserves and surplus, or 2. Excess of expenditure over income, which is deducted from the surplus and reserves, which is shown at the liability side. 5. Illustrations. Non-current assets, purchase of land, building, machinery, furniture and their installation expenses are not regular expenses. On the other hand, routine administrative expenses like salary, postage, stationery are regular expenses. The third category of expense is deferred revenue expense. Capital expenses are recorded in the balance sheet, asset side, and revenue expenses are recorded at the debit side of the income and expenditure account. Let us understand the concept of deferred revenue expenses and its accounting treatment. Deferred revenue expense. The nature or capital expense is very precise, and that is non-recurring in nature, and the same is with revenue expense, that is recurring in nature. The third category of expense is mixture of capital and revenue expense. In the initial stage, it is treated as capital expense, and gradually every year some part of that is transferred to the profit and loss account as revenue expense. The benefit of revenue expense is for that year in which it is paid, but there are certain expenses for which the benefit is available in a certain subsequent year along with the year in which they are paid. Thus, instead of writing off these expenses as revenue expenses of that year in which they are incurred, they are allocated over estimated numbers of year for which the benefit will be available, or allocated to a predetermined number of years. This means they are written off proportionately. This expense is known as spread expense or deferred revenue expense. The amount written off is disclosed at the debit side of income expenditure account. The portion of this expense which is not written off is disclosed on the asset side at the end of the balance sheet. Example, building color work, ground leveling expenses, advertisement expenses, etc. Let us understand it with illustration. 1. Salary paid rupees 12,000. 2. Rent expenses rupees 4,500. 3. Dividend received rupees 6,000. 4. Commission received rupees 7,500. 5. Furniture purchase rupees 25,000. 6. 5 years bank loan obtained rupees 60,000. 7. Advertisement expenses paid TV channel for 3 years rupees 9,000. Explanation for the transactions. Transaction 1. Salary paid rupees 12,000. The accounting effect would be revenue expense to be recorded debit side of income and expenditure account. 2. Rent expenses rupees 4,500. The transaction effect would be revenue expense to be recorded debit side of income and expenditure account. 3. Dividend received rupees 6,000. The effect would be revenue income to be recorded credit side of income and expenditure account. 4. Commission received rupees 7,500. The effect would be that revenue income to be recorded credit side of income and expenditure account. 5. Furniture purchased rupees 25,000. The accounting effect would be capital expense to be recorded at asset side of the balance sheet. 6th, 5 years bank loan obtained rupees 60,000. The capital income to be recorded at liability side of the balance sheet. 7th, advertisement expense paid to TV channel for 3 years rupees 9,000. This is a deferred expense. It is to be recorded at asset side of the balance sheet. In the first year, rupees 9,000 would appear at asset side, and from that for the first year 3,000 will be deducted and remaining 6,000 would appear in the balance sheet of the first year. This deducted 3,000 rupees will be shown on the debit side of income and expenditure account as an expense of the current year. Conclusion. In this module, we have studied 1. Meaning and characteristics of non-trading concerns. 2. Difference between trading and non-trading concerns. 3. Components of final account of non-trading concerns. 4. Meaning of capital income and revenue income and capital expense and revenue expense. 5. Difference between capital income and revenue income. 6. Difference between capital expense and revenue expense, and 7. Deferred revenue expense. We have also covered an illustration. In the next part of accounting for non-trading concerns, we will study about 1. Special terminologies used in accounting for non-trading concerns. 2. Classification of incomes and expenses for non-trading concerns. 3. Components of annual accounts of non-trading concerns. I hope this was helpful for you. Thank you.